Have you ever wondered why every country on earth is drowning in debt and who they actually owe all this money to? Because here's the surprising truth. Countries don't borrow money the same way you and I do. Their debt works differently, it's bigger, and it has a massive impact on your investments, your currency, and even your trading results. Welcome back, traders. In today's video, we're diving into a topic that sounds complicated, but once you understand it, you'll see the financial world with completely new eyes. We're talking about global debt, why nations owe trillions, who lends them this money, and why the system keeps growing bigger every year. And trust me, once you understand this, you'll understand interest rates, inflation, why currencies gain and lose strength, and even why stock markets crash sometimes. Because the debt system is like the invisible engine behind the global economy. When it speeds up, markets rise. When it breaks, markets fall. Now, if you're new here, don't worry. I'm going to explain everything step by step in a simple and beginner-friendly way. No confusing jargon. No boring textbook definitions. Just clear, practical explanations, just like I teach my trading students. So here's what we're covering in today's video. Why every country is in debt, even the richest ones. Who they borrow money from is, and some of these will surprise you. Why governments can keep borrowing without going bankrupt like normal people. How this global debt affects your money, your savings, and your trading. And how smart traders use this knowledge to make better decisions. You're about to discover the truth behind something most people never think about, yet it impacts their daily lives. From the price of groceries to the interest rate on their loan and even the performance of their stock portfolio. And here's the crazy part, this system is designed to always keep growing. Countries keep borrowing more, lenders keep lending more, and the global debt keeps rising year after year. But why? And how long can it continue? That's exactly what we'll break down step by step. By the end of this video, you'll understand why your country has debt, who owns that debt, why governments rarely pay it back, and how this ties into inflation, central banks, and market cycles. So grab your notebook, sit back, and let's jump into the world of global debt. Explained in a simple, practical way that actually makes sense. Because once you understand how governments manage money, you'll understand how markets move, and that gives you a real advantage as a trader. Let's get started. Most people never think about government debt. They hear numbers like trillions on the news, but it feels so far away, so complicated that they just ignore it. But here's the real problem. What your government owes affects you directly. Your income, your savings, your currency, your cost of living, even your future opportunities. And beginners in trading or finance often struggle because they don't understand how these big forces shape the markets they're trying to trade. Let me explain. When a country is drowning in debt, it doesn't just affect the government, it affects the entire economic system. And if you're a trader or investor, ignoring this is like driving blindfolded. You can't understand interest rates, currency movements, inflation, or market trends unless you understand why countries borrow and how that debt influences everything around it. Here are some common struggles beginners face. 1. They think government debt is the same as personal debt. This is the biggest misconception. People assume that if a government has debt, it must one day pay it back just like a person or a business must. And when they see trillions in debt, they panic. This is impossible. The system is going to collapse. But they don't realize that government debt works differently because countries can print money, raise taxes, issue bonds, and grow the economy. Beginners don't understand this difference, so they misread economic trends or market reactions. 2. They don't understand who the government actually owes. Ask the average person, who does your country owe money to? Most will say, other countries. But that's only partly true. Countries borrow from investors, banks, pension funds, central banks, their own citizens, international institutions, foreign governments, without understanding who holds the debt. Beginners can't understand which groups benefit when governments borrow and who suffers. 3. They don't see how debt affects inflation. When governments borrow too much, they eventually have to do two things: print more money, raise taxes. Both of these impact the price of food, the value of your savings or your purchasing power, the strength of your currency. Beginners often wonder, why is everything getting more expensive? Why is my currency losing value? They don't realize that government debt is one of the key drivers behind inflation. 4. Traders misread market reactions to government decisions. When governments increase debt or when central banks adjust interest rates, it creates ripple effects in stocks, commodities, currencies, bonds, crypto. But without understanding what national debt really is, beginners guess instead of making informed decisions. And in trading, guessing is the fastest way to blow up an account. 5 people fear economic collapse without knowing the real mechanics. News headlines say debt crisis, government nearly defaults, national debt hits record highs. Beginners panic because they don't understand what default actually means, why some countries can borrow more safely than others, why some nations collapse while others survive with even bigger debt levels. This lack of clarity creates fear, confusion, and bad decisions in both personal finance and trading. And this is why today's topic matters so much. Because once you understand why countries borrow money, how the system works, and who they owe, you'll see global markets with crystal clarity. You'll understand why currencies rise and fall. You'll understand what drives inflation. You'll know how governments keep the economy running, even with massive debt. And most importantly, you'll be able to make smarter trading decisions. Now let's break down the big question: why is every country in debt and who do they owe this money to? You're about to understand this in the simplest way possible, step by step, no jargon, no confusion. 1. Why countries borrow money? Countries don't borrow because they're poor or because they're irresponsible. They borrow because the global economic system is designed that way. Here are the 4 main reasons governments take on debt. A. To grow the economy. Imagine a government wants to build roads, railways, schools, hospitals. These projects cost billions, sometimes trillions. Governments don't want to raise taxes every time they need money. People would revolt. So instead, they borrow by issuing government bonds. This borrowing grows the economy, creates jobs, and increases productivity. B. To stimulate the economy during recessions. When economic problems happen, like COVID, financial crisis, or slowdowns, governments spend more to support businesses, workers, banks, infrastructure. But during bad times, tax revenue goes down. So how do they pay for all this? They borrow. C. To fund government services. Every government needs money for defense, healthcare, education, social programs. But sometimes the spending is higher than the tax income. This is called a budget deficit. To cover the gap, the government borrows. D. Because debt is actually cheaper than raising taxes. Raising taxes is politically dangerous. Borrowing, however, is easy. Investors happily lend to governments because government bonds are considered safer than stocks or corporate debt. 2. How countries borrow money? Most of the time, countries borrow by issuing government bonds. A government bond is simply a loan from an investor to the government. You lend them money. They promise to pay interest. They pay you back later. These bonds are bought by investors, pension funds, banks, insurance companies, foreign governments. That leads us to the next part 3. Who do countries actually owe? This is the part most people misunderstand. Countries owe debt to many different groups, not just other nations. Let's break it down. A. Domestic investors inside the country. This includes banks, pension funds, insurance companies, mutual funds, citizens who buy savings bonds. This is often the largest group. B. Foreign governments. Some countries lend to others by buying their bonds. For example, country A buys bonds from country B. Country B uses that money to fund its spending. Country A earns interest. C. International organizations like IMF's International Monetary Fund, World Bank, Asian Development Bank, European Central Bank. Countries borrow from these institutions for development and emergency loans. D. Central banks like the Federal Reserve, ECB, Bank of Japan often buy their own government's bonds. This is how they control interest rates, inflation, money supply. When a central bank buys government bonds, it's basically the left hand of the country lending to the right hand. 4. Why countries rarely pay off their debt. Here's the surprising truth: governments almost never pay off their debt fully. They just roll it over. When old bonds expire, new bonds are issued. The debt continues, but the economy grows. So the debt to GDP ratio becomes manageable. This is normal. This is how the system is designed. If a country tried to pay everything back at once, it would destroy its economy. So instead, they manage debt year by year. 5. Why this system keeps growing? The global financial system is built on credit. Debt fuels growth, innovation, infrastructure, jobs, government spending. Without debt, economies would slow down dramatically. That's why every year, governments borrow more. And investors are happy to lend because government bonds are safe and pay interest. Now that you understand why countries borrow money and who they owe it to, let's make this even clearer with a real world example. We're going to zoom in on a situation that happens in every country, no matter how big or small. And by the end of this section, you'll see exactly how government debt connects to inflation, interest rates, and even your trading decisions. Imagine this: a country called Econland. To keep things simple, let's create a fictional country called Econland. This makes it easy to understand without the politics or complexity of real nations. Econland's situation: Econland earns money from taxes. Let's say the government collects 1 trillion in taxes each year, but it spends 1.3 trillion on infrastructure, salaries, healthcare, military, and public services. That means Econland has a budget deficit of 300 billion. So what does Econland do? Raise taxes, cut salaries, reduce spending? No. Like every modern country, it borrows the money. Step 1, Econland issues government bonds. Econland says, we need 300 billion. We'll issue bonds. Anyone who buys these bonds will earn 3% interest per year. Who buys these bonds? Banks, pension funds, insurance companies, foreign governments, individual investors, Econland's own central bank. Just like that, Econland fills the 300 billion gap. Step 2, how this debt affects the market. Now, here's where it gets relevant for traders. A. Bond yields rise or fall. If Econland's debt grows too fast, investors demand higher interest rates because they want more compensation for the risk. Higher bond yields impact stock markets. C. Often go down. Currency value. A. Can strengthen or weaken depending on demand. Foreign investment, the money flows in or out. Example: if bond yields rise from 3% to 5%, many investors sell stocks and buy bonds instead. This can trigger corrections or slowdowns in the stock market. Step 3, Econland gets into a tough spot. Let's say Econland goes through a recession, people lose jobs, businesses close, tax revenue drops from 100 trillion to 800 billion, but government expenses rise to help support the economy. Now the deficit becomes even bigger. Econland still needs money, so it borrows more and issues new bonds. Step 40, the central bank steps in. Econland central bank thinks, if borrowing costs get too high, the economy will collapse. So what does it do? It buys Econland's own bonds. This reduces interest rates, encourages borrowing, and stabilizes the financial system. But there's a catch. When the central bank buys too many bonds, it increases the money supply, which can lead to higher inflation, a weaker currency, rising asset prices, stocks, housing, commodities. This is one of the reasons markets like stocks and gold rise when central banks print money. Step 5, how this affects you as a trader. Here's where it becomes practical. A currency traders, if Econland prints more money, its currency weakens. A weaker currency often leads to higher exports and lower imports. As a forex trader, recognizing this early gives you an edge. B. Stock traders, if interest rates rise, stocks often fall. If interest rates drop, stocks often rally. Government debt strongly influences these movements. C. Commodity traders, gold and oil often react to inflation expectations, currency strength, interest rate changes, all of which are influenced by government borrowing. Step 60, what happens next? Over time, Econland's total debt grows from 300 billion to 500 billion to $1 trillion to $2 trillion. And guess what? This is normal. This is exactly how real countries like the US, Japan, and many European nations operate. The economy keeps growing. Debt keeps rolling over. Investors keep lending. and the system continues. By using this simple econ-land example, you now see how government debt isn't just a big political number, it's a system that affects markets, traders, currencies, inflation, and your financial future. Now that you understand why every country is in debt, how they borrow, who they owe, and how this affects the global markets, let's simplify everything into clear, practical takeaways. These are the key points every beginner must know, especially if you want to become a smarter trader or investor. 1. Government debt is not always bad. It's a tool most beginners panic when they hear trillions of dollars in debt. But here's the truth, debt is a tool. It can grow an economy or destroy it depending on how it's used. When used wisely, debt funds infrastructure, technology, education, public services, economic stability. This creates jobs, boosts productivity, and expands the economy. But when used irresponsibly, like overspending, corruption, or borrowing without growth, debt becomes dangerous. The lesson: don't assume a country with high debt is automatically failing. Look at how the debt is being used and whether the economy is growing faster than the debt. 2. Not all debt is equal. Understanding who holds the debt matters. A country owing money to itself through domestic investors or its central bank is very different from owing money to foreign countries. Here's the difference. Domestic debt, safer, easier to manage, can be controlled through local policies, lower risk of default. Foreign debt can weaken the currency, creates repayment pressure, may cause crisis if foreign investors pull out, often requires higher interest rates. The lesson: a country with high domestic debt can survive. A country with high foreign debt can collapse quickly. As a trader, always watch the ratio. 3. Government debt affects inflation and interest rates. This one is huge for traders. When a country borrows too much, it often leads to central banks printing more money, lower interest rates to keep borrowing cheap, higher inflation, a weaker currency. This influences everything you trade, including forex, currency pairs, stocks. Higher inflation hurts growth stocks, commodities. Gold rises when inflation rises. Bonds yields move with inflation expectations. The lesson: if you understand a country's debt cycle, you can predict inflation trends, interest rate decisions, and market movements. 4. Debt creates trends in the market. Use them. When governments borrow heavily, bond yields rise or fall, currencies strengthen or weaken, stocks rally or correct, commodities adjust. This creates long-term trends that traders can follow. Examples: high inflation, gold often trends up, rising rates, big growth stocks drop, value stocks rise, currency printing, gay FX pairs break out. The lesson: debt drives macro trends drive markets drive trading opportunities. 5. You don't need to predict, you just need to understand the flow. Markets move because of money flow. When governments borrow, money enters the system. When central banks buy bonds, money supply increases. When interest rates rise, money leaves risky assets. When countries increase debt, their currencies often weaken. Understanding this allows you to trade with the big players, not against them. You don't need to predict the future, you just need to recognize cause and effect. 6. Global debt will keep growing. And that's normal. Many beginners think the system will collapse because debt keeps rising. But in reality, debt grows as economies grow. Debt rolls over instead of being paid off. Inflation reduces old debt. Governments borrow more as populations increase. This is the design of the global economic system. The lesson: don't fear the size of global debt. Focus on whether economies are managing it sustainably. These key takeaways will help you read markets with more clarity, understand long-term trends, and avoid common beginner mistakes. You now have the foundation to think like a macro trader, someone who understands the big picture behind every chart. Before we wrap up today's video, I want you to take a moment and think about what you just learned. You now understand something that most people never learn in their entire lives. Even though it affects their money, their job, their currency, their savings, and their financial future every single day, you now understand why every country is in debt, how that debt works, who governments owe, and why this system shapes everything from inflation to interest rates, from your grocery bill to the stock market. And let me tell you this, most traders never study this. Most traders only look at charts. They don't understand the bigger picture, the forces that move markets long before price ever changes. But you're different. You're taking the time to learn. You're building a mindset that helps you trade smarter, manage risk better, and read the market like a professional. And that's something you should be proud of. Now, if you enjoyed this breakdown and you want more videos that teach you the big picture behind the markets in a simple, step-by-step, beginner-friendly way, then make sure you're part of this community. Here's what you should do right now. 1. Like this video. It really helps support the channel and it tells YouTube that this kind of educational, no nonsense content is valuable. The more you engage, the more people can learn just like you. 2. Subscribe to the channel. If you're new here, hit that subscribe button. I upload videos that simplify trading concepts, explain market mechanics, and help you avoid the mistakes 90% of traders make. You get clear explanations, real trading examples, practical tips, strategies for building long-term consistency. This is the kind of training I wish I had when I was starting out. 3. Turn on notifications. YouTube doesn't always show you new videos unless you click the bell icon. So turn on notifications to make sure you never miss an upload. Especially topics like why currencies rise and fall, how central banks move the market, why traders lose money, how inflation affects your trades, and step-by-step trading guides. If you're serious about improving, you don't want to miss those. 4. Comment below. I want to hear from you. Tell me in the comments what surprised you the most about government debt, which part was the clearest, and what topic do you want me to break down next. Your comment helps me create even better videos for you, and I read every single one. 5. Share this video with someone who needs it. Maybe you know a friend who's confused about inflation, or someone who's always asking, why is everything getting more expensive? Or a beginner who wants to understand the global economy. Share this with them. You might help them make smarter financial decisions. You're now ahead of the majority of people who only see headlines, panic, complain, or blame the system, but never study it. You're learning how the financial world actually works, and that knowledge puts you in a much stronger position as a trader and as an individual. So keep learning, keep improving, and keep taking steps toward becoming a confident, well-informed trader. Thanks for watching, and I'll see you in the next video. Until then, stay safe, stay disciplined, and continue leveling up your financial knowledge.